one call out I'll make up front, and hopefully this resonates to the developers in the Mid-Atlantic. There's a ton of focus on supply coming down in the sunbelt. Supply is also coming down on the coasts and coming down particularly in the suburban coasts. So I do think it's going to be a benefit as you look out over a multi-year period. Obviously, there's less starting. That's going to be less competition. But I think there's an over kind of heightened focus on supply coming down in certain markets where I think it'll happen in the overall industry. I'm generally of the view that there is going to be a longer tail from supply, particularly in places that are seeing, go into the Austins of the world, just historic levels of new supply coming through the system.
Prominent CEOs, leading economists, iconic investors, insights from the experts. The Walker Webcast with Willy Walker. See who's next.
Nice to see you all here. Ben, thank you for joining us.
Yeah. Thanks for doing this, Willy.
I'm going to turn this chair a little bit this way so I can look this. So I'm from the DC area, and when I come to town, I stay with my parents. And I think most of my friends who hear that I stay with my parents kind of get a big chuckle that I don't stay at some fancy hotel and stay with mom and dad. But I raised this story because this morning I woke up to get out here at 6:45, and I'm in the shower, and all of a sudden I hear a knock at the door, and it was my 86-year-old dad making sure that I was up in time to be here. and it made me feel like I was in 6th grade back at St. Albans. And I don't think anyone has worried whether I'd gotten up for an alarm in many, many years, but it was a really cute moment this morning. Where'd you grow up, Ben?
I grew up in New Jersey, most of the time in southern New Jersey, sort of the Cherry Hill area, suburbs of Philadelphia. I'm on the other end of the spectrum. I woke up at 5:45 this morning to get my older son up so he could get to early basketball practice. So.
At GDS. So how'd you end up going to Swarthmore? You were a basketball player in high school. How'd you end up going to a small liberal arts college in Pennsylvania?
Yeah, I've got a long family connection there, so that was at the core. But up until my junior and senior year, that was not sort of my expectation. Winded up just being a great fit academically, place I could go and play sports, small, intensive academic environment. Loved it, ton of value out of it, and I've stayed very close and connected to the school since then.
And when you were at Swarthmore, did you think that you wanted to go into commercial real estate? What was it that took you down that path?
Not anywhere on the radar. Swarthmore, traditional liberal arts education, great place to learn, great foundational set of skills. But at the time, I don't think they even had one business class, let alone one class in real estate. This advances a little bit further. I really didn't get my first taste of real estate until I was a couple years out of college, and I was working for the New York City Economic Development Corporation. And one of the roles of that organization was to sell city-owned land to private developers. And so I quickly sort of like, you know what, I want to be on that side of the table, sort of, seeing how the developers were buying land from a city organization, and then use business school to really make that transition to get into the space. But I didn't grow up, not somebody who grew up in a family of real estate people, didn't really have exposure to it. And it's winded up just being a great fit for sort of how my mind works and what I enjoy, and, what kind of gets me passionate about, particularly today, how we can create places, and, this gets to AvalonBay's purpose, but creating a better way to live, just increasingly spoke to me, as a leader.
Was Sean Donovan running New York Housing Authority back then when you were in this?
No, it was I think I was there a couple years earlier.
Okay.
Yeah.
So you end up going to HBS. I took a look, and there are 112 Swarthmore grads who've gone to HBS. Was there another Swarthmore grad in your class at HBS?
There was actually, and it was actually my college roommate. He's out there.
Roommate.
And my college roommate. We took two different paths to get there, and we're in two different industries, but we did wind up there at the same time.
And what did it feel like showing up in that section for the first day when everyone from Yale and Stanford sitting there talking about their resumes, and you're saying, I went to Swarthmore and worked for the New York City government before coming to Harvard Business School?
Yeah, I was definitely kind of on the outside. It wound up being great for me because I went there to get the harder set of skills, but as you know, I mean, you're sitting there with the private equity guys and the investment bankers of the world, and they've been driving hard in that way for a while. I loved HBS. I mean, it was an awesome place. I mean, I enjoyed it socially, some great friends and network, business training, and then the power of it was allowed me to make the switch, right? I mean, it gave me the opportunity to make that switch, particularly during my summer, and we can get into this story, but I winded up sort of banging on a ton of doors, and got into Vornado as my kind of kickoff in the real estate space. People probably know Sandeep Mathrani. We did GGP and then WeWork and lots of other things, but he was the guy that gave me my first shot in the industry.
I'm sure you were a star on the intramural basketball court at HBS.
We played a lot of basketball there.
I thought you.
I don't know if I would say star, but we definitely played.
I thought
definitely an everyday activity.
Yeah, that competitive nature runs deep there. Yeah. So you're at Vornado, and then you go to the Rouse company. Talk for a moment about the move from Vornado over to Rouse, and you were COO at Rouse, correct?
Yeah. And for folks in this room and from this area, it's critical to differentiate between sort of the original Rouse and the new Rouse. And people who are associated with the original Rouse don't necessarily love the use of the new Rouse name. I'll give a little bit. My time at Vornado was an amazing experience, super entrepreneurial place, type of place that would give young executives just tons of experience, varied experience. I'm thankful to people like Steve Roth and Mike Fascitelli and Sandeep for effectively just giving me opportunities that I was not ready for. And it really did help accelerate my career. And the reason I kind of start there was one of my primary functions at that time, kind of as an early buck in the space, was Steve had a lot of old, decrepit shopping centers. They were occupied, they were by, Bradley's, and it was actually originally the old two guys from Harrison's. And so you had all this real estate that needed to get redevelopment. And what I cut my teeth there in really being somebody who could organize a team to think about repurposing space for higher and better use. And that's sort of the early part of the theme of my career, which is being able to sort of be a guy who can kind of bridge the world of kind of development, re-envisioning space, thinking about, what's going to drive customer demand by doing it in a world of sort of the public company setting. And so I was there for 10 years. I wound up running their suburban retail business. After I left, it wound up being spun off. So it's now Urban Edge for people that know that business. But all of that was a build-up to Rouse, which the new Rouse was a spin-off from GGP. And literally, people referred to this new company that I joined as the dead mall company. Like that was how people were like, you're going to go to this dead mall company. But the purpose of it was generally a set of malls in smaller markets that had just been forgotten about. And so what we tried to do was to reconnect those malls back to the communities in which they operated. And they had been owned by this big corporate behemoth of GGP and really just had gotten no attention. I started going out to these sites and I'd be the first executive that, these teams had seen in 10 years, right? Just completely forgotten about. The other premise of it was we needed to re-envision what we were going to do with these old mall boxes, right? I was sort of like the early throes of the end of the department stores as the anchor of these boxes. And so we were thinking we were early on that journey of thinking about new uses, alternative uses, retail, non-retail, and again, kind of continuing my career journey down the path of kind of re-envisioning space through this development angle and how to best reconnect it to the communities in which it existed.
Start a legacy. Start turning dreams into realities. A better world begins with you. Better communities start with us.
And so then you go to Seritage and become CEO there, mixed use developer, retail. What were the challenges going from, I mean, it sounds like going from Vornado, which was extremely well established and, had a great market presence, to Rouse, where you were dealing with sort of the kick out of GGP, to then Seritage. Talk for a moment about A, being CEO of a publicly traded company for the first time, and then B, the portfolio you stepped into.
Yeah. So, it was a really unique opportunity. So for folks that don't know, Seritage was formed as a spinoff of Sears. There was 40 million square feet of real estate that was being spun out to figure out how to redevelop it into higher and better uses.
Did Eddie Lampert have a role in?
He did, yeah. So
Seritage?
he wound up being the largest shareholder in it. So if you were a shareholder of Sears, you got a share of this new company. And so he was a large shareholder. He was the chairman of the company for a long time as well. I'll start with sort of the was my first seat and first time in a CEO seat. What was really unique about it was we started it from scratch. So I was employee number one. My assistant I brought with me was employee number two. And part of that journey, and this starts to then inform what then brought me to AvalonBay, but it was the first time where I could really think about the culture that I wanted to build in an organization and how to bring together a group of people who believe similarly about cultures of an organization, how we wanted to lead, and what was critical there. So, pretty rare in your career where, Vornado had a very established culture, AvalonBay has a very established culture. That was sort of a spot point in time where I could think about what it meant to me to be a leader of a real estate organization. And really try to create something that I thought would inspire a group of people to come together. And we were doing it in a super, super entrepreneurial type of environment. The real estate side, 40 million square feet, blank canvas, was sort of the ultimate redevelopment opportunity. And a lot of it was repurposing in and around retail. But it did start to get me involved in thinking about housing uses for a lot of these sites. Which was sort of my early entry and, more kind of the more significant time that I started to spend in and around potential apartment opportunities and meeting folks in that world as we thought about repurposing some of the real estate.
And so as I look at your background and look at Vornado into Rouse into Seritage and the asset classes that you were working on, multifamily is not completely out of the picture, but not really there. So as the board of directors sits around at AvalonBay to say who's going to replace Tim, how did Ben get to the top of that list?
I was very clearly not a multifamily guy. Touched it as I talked about and as you referenced, but not a multifamily guy. And this brings it back to culture. AvalonBay has got a long-standing evergreen culture. Actually goes back to our original founders. Some of you from the region probably know them, Dick Michaud, Chuck Berman. In the mid-90s, they were a Trammell Crow company. They were thinking about creating a separate company, and they asked themselves, what would create an evergreen company? They were HBS guys. At the time, Jim Collins was obviously big, good to great. And what they landed on in terms of what was going to separate AvalonBay over time was our culture. And the cultural values that they set then remain the cultural values that we have today. And the three lead cultural values are a spirit of caring, integrity, and continuous improvement. Which for me, when you think about you want to wake up every day, think about your North Star. If you focus on those three items, you'll get to the right place. There are also three items that really spoke to me as a leader. And this goes back to kind of the culture I built at Seritage. A lot of connections in terms of how I think about leadership, how I think about bringing together partners of leaders as an organization. And that at the end was, as AvalonBay is going through and thinking about who they wanted to have in the seat. Obviously, there's the aspects of, having somebody who's run a public company, right, and dealt with strategy and dealt with capital allocation. But at the core of it was this, as Tim and I started spending more and more time together, and I spent more time with the board, it was that connection around culture. And I very much see my role at AvalonBay. We've been around for 30 years, amazingly successful throughout cycles. One of my key roles is just being one of those next stewards of our culture.
And when you looked at AvalonBay, Ben, from an outside of taking the CEO role, as you looked at the assets, when you were looking at it in 2021, you're in coastal and coastal suburbs. In 21, those weren't the hot markets to be in. The hot markets to be were in sunbelt, and big growth was happening in sunbelt. As you looked at that, did you think that that would be if right now you're really happy where you are, and I want to talk about that in a second, but as you looked at it in 21, did you sit there and say, we've got assets on coasts and in gateway cities and suburbs of gateway cities that could be a drag versus being at some of the other REITs that have assets in the Sunbelt?
Yeah, I mean, when I joined AvalonBay end of 20, early 21, people kind of think back, like there was a question of like, are people going to live in urban apartments just generally, right? Like what's that environment going to be like? Are people going to feel safe? So it's definitely been a roller coaster, through the apartment industry, and also in our portfolio. To your question, Willy, our movement to both the suburbs, which has been a big push, sort of continuing our push to the suburbs, and our push to what we refer to as our expansion markets, which are a subset of Sunbelt markets, started before I was there. We kicked off moving to Southeast Florida, in Denver. This is now kind of like 5 or 6 years ago. So the process was underway. I'd say as we brought the management team together and as I stepped in as the CEO, this was a very successful business, right? This was not a broken type of situation. This was a very successful business. And so what I focused on and what we focused on as a team is how do we need to continue to evolve our business given the changing environment? And so when we get and talk further about our movement into these expansion markets and the reasons for it, it's just a continued evolution of our business that we think will better position us for superior growth in the years ahead. And a lot of the portfolio allocation is it's an optimization and really tailoring our portfolio to those markets. And I can talk some more about the themes that are there. Big part of it is just following our customer. Right? Like we recognize that more and more of what we think about the AvalonBay core customer, that knowledge-based worker, is in a more dispersed set of markets, right? So let's find the markets where those customers are going to be that have the attributes that we think about delivering strong, long-term apartment growth. And let's take what we do well and bring it to those new places, right? It's an expansion of our opportunity set.
Talk for a moment you talked about your client being the knowledge worker.
Yeah.
What have you done from an amenities standpoint to match up what an AvalonBay community is offering to that knowledge worker?
Yeah, that is definitely in the realm. We're constantly evolving it based on customer feedback. We got Kurt Conway in the room who runs that part of we're constantly out talking to our existing residents. Every new project, we're constantly getting feedback. And so it is a constant evolution. So the amenity space kind of transition, I'd say, over the last 3 to 4 years, has a couple of different themes. One, flexible space, right? So the old model of sort of defined, distinct leasing office space from common area space, we've broken down those boundaries completely. So it is now flexible space where our associates are out interacting with existing residents or prospects. That's one. In a lot of climates, that flexible space is also creating indoor-outdoor spaces that can flex over time, everything from kind of fitness being indoor and outdoor, but also how people want to spend their time when they're in our amenities. And then more recently, we also, we spent a lot of time thinking about where people want to, if they're spending more time at home working, where do they want to spend that time? And that's led us down a couple of different paths. One is the apartments we're building are actually different. And this is an interesting differentiation for AvalonBay. As a developer, we're the most active public developer by far, but also as long-term holders. It leads us to development decisions that are different than what I would refer to as sort of the typical merchant build model. And so what I'll call out there is the apartments that we're building today are 100 square feet larger than they were 4 or 5 years ago, which is actually not where a lot of the industry is going. And so I reference that because as you think about people wanting to spend more time at home, we're actually building larger units, and where we can, building in lofts, dens, those types of spaces. And we're able to do that with a little bit less of a mentality on thinking about maximizing per unit values and thinking about what's going to really retain and drive rental growth over the long term. And then bringing back to sort of the common area space, we've evolved to, if people are going to come out of their apartment, what they want is they want an individual quiet space for them to work and do their calls. So we've drifted away from sort of like the big communal table where you're expecting people to be kind of working there. Now if as much as we can, we're building 50 square foot glass enclosed areas for people to have their quiet time. That's what's going to get them out of their apartments to come down and work. And there's real value that customers place for that amenity.
Anything from a technology standpoint?
Yeah, huge amounts on the technology side. Maybe I'll describe this in just generally our operating model journey, which has been probably the most significant change at AvalonBay over the last 5 or 6 years. And I'll describe it this way, which is we now lead in our interactions with customers and prospects through AI. We were very early. People are probably aware of, it used to be called Meet Elise. It's now Elise AI. We're now using that technology. We were early investors, early adopters, really helped shape that technology. That technology now handles 95% of our prospect interactions. And we're now taking that type of technology and using it throughout the customer journey. But I start there and emphasize there, which is if you're a customer of ours, your first interaction with us, we want to be AI based. If AI can't handle your situation, the other big shift is we're continuing to invest in centralization. So we're one of the first in the industry to have a centralized service center. Typically, it was very back office oriented. It's now shifting to both back office and front of the house, and continues to get a lot of investment. That's the second landing spot. Then you get to a team, and you get to an on-site team. And the big shift there is the old model of having dedicated staff at individual properties. We are moving, and others in the industry are as well, to neighborhooding, right? Where they're now a team that's handling 4 or 5 assets in a neighborhood. And it's allowing us, when you put that together with the technology centralization and the neighborhooding, we feel we can deliver a higher value proposition to customers. And we do measure that through NPS and other factors, delivering higher value proposition and doing it much, much more efficiently.
A lot in there that I want to dive into. One of the things that you were talking about using AI to screen your tenants. There are 2 companies that I've looked at recently as it relates to the impact of AI. One of them is a company called Teletech, which is a big call center company. The other one's a company called Chegg, which is a big online learning company. Both Teletech and Chegg 2 years ago were $5 billion market cap companies. I think today Teletech's market cap is $250 million and Chegg's is $240 million. Both of them, if you pull them up on your phone, are just straight down to the right. And the reason is that exactly you would have used theoretically a Teletech call center previously to potentially pre-screen AvalonBay clients. Today, AI is doing it. They're not calling a Teletech call center. So straight down. Yeah. And then Chegg, my kids who are in college would use Chegg to help them with their homework and writing a paper and pulling it all together. It was online help as it relates to sort of an online tutor. Now you can go to AI and get all that stuff for free. And as a result of it, Chegg's stock price is just cratered. And I just think it's really interesting to watch how AI is both enabling companies to do certain things and then also the consequences of being an industry that AI can potentially completely disintermediate.
Yeah, for sure. And when it works well, I'll use Elise AI, you get the strategic benefits, you get the operational benefits, and you get the investment benefits. So Elise AI, I mean, it was nothing of a company, right? So very small valuation, just had a funding raise north of $1 billion, right? And so it's worked for them by getting a strategic partner like us involved early adopter, constant feedback, and it's great for us because we're at the table with them.
Right.
Actually tell, like, we need you to tailor the product in this way, right, to help us execute what we need to execute. So when we do a decent amount of prop tech investing, those are the types of relationships that we try to find, right, where we can have both the strategic benefit as well as the financial benefit.
Are you the only large scale operator who's an investor in Lease AR? Or did they go out to a consortium of?
So early on, the two were us and EQR. So it was the two of us. Now it's a much broader customer base,
Yep.
but it was really the two of us early at the table coming together to make the investment and spend the time with them.
And you talked about your neighborhood teams, Ben. Does that mean that as you look to either buy assets or develop assets, you're very focused on co-location in certain MSAs rather than more diverse development and acquisitions?
For sure. And I'll take it further, which is we're now taking, it's really the combination of technology, centralization, and neighborhooding, and incorporating that into our underwriting of assets. And we now are, a typical asset, if we can have it in the correct neighborhood, we feel like we can generate 30 to 40 basis points of incremental yield by having that asset on the AvalonBay platform. And we were not that the operational journey was there a couple years ago, but we were not underwriting that type of benefit. And so it speaks to, my view and our view that in our industry, in the multifamily industry, scale is going to be increasingly important, particularly driven by the investments that are needed to be made in technology, centralization, and then the benefits that are increasingly going to come through having clusters of assets together.
And so a couple things as it relates to your growth. You mentioned previously some of the new markets that you're going into. If you think about the portfolio today, it's gateway suburbs, which, as I said previously, has turned out to be a fantastic place to be over the last 2 years during the Great Tightening, as we've had massive oversupply to sunbelt markets. As you look at that footprint, continue to invest in that, if you will, suburban coastal footprint, or go more towards the large sunbelt markets that have had so much supply recently? I know, for example, you've got a shovel in the ground in Austin, Texas.
Yeah.
That is a market that has gotten 8% new supply in 2024 to it. You are very bold in going in there, but I consistently sit around and talk to people and say, you give me an option today to buy in Cleveland, Ohio, which has been a great market for the last 2 years as it relates to being able to push rents, or Austin, Texas, which has not been the greatest market to be in for the last 2 years. I'm going to Austin, not to Cleveland, Ohio. Clearly putting a shovel in the ground in Austin has, being able to do that. You're one of the few that can do that, given your balance sheet and your ability to finance it. Why Austin, first of all, and then second of all, go back to that first question I had as it relates to where the growth is going to come from.
Yeah. Let me dig in a little bit. Our conviction on the suburban coasts remains very, very strong. In the near term, recently, and in the near term, continue to benefit from steady demand and just low levels of new supply, right? And so that's, you're seeing that come through our operating results, the momentum we had in the business. This year we're posting, of the public peers, sector leading revenue growth in the 3.5% type of range. But it's not just the near term. I mean, we've been pushing this way as we're constantly, this goes back to my evolution theme. We're constantly thinking about what are the trends that are going to be influencing our business over the next 10 to 20 years. And demographic trends, and particularly the aging millennial trends, along with what's happening from a regulation standpoint, being kind of two main factors, continues to have us push to the suburbs. And Matt Birnbaum, my CIO, kind of puts it this way: to a certain degree, we think our portfolio, our suburban coastal portfolio, is better positioned to capture rental demand over this next 10 years than it was over the prior 10 years. So you're going to continue to see that be the core of our portfolio. Today we have about 90% of our portfolio in those suburban coastal markets and 10% in our expansion markets. And as we think about optimizing that portfolio, we want to get that 10% to about 25%. As we're making that shift and we pursue that growth, it's through multiple channels: acquisitions, development, and then also funding of other developers. Let me kind of turn to the Austin example, because I think it speaks to what I consider one of the true strengths of AvalonBay, which is our sort of detailed intensive focus on both which markets and how we think about the timing of entering those markets. So in Austin, we announced that we wanted to be in Austin 3-4 years ago. We started our first development project 2 months ago. We bought our first deal 30 days ago, right? So we're positioned as the type of company that can be patient to figure out when we think about that overall market, but when's the right time to enter that market. And so when I look at Austin today, the next couple of years, probably still some continued pain, right? I mean, there's still a lot of deliveries that are coming through, particularly in certain submarkets there. But as we think about over the next cycle, and I think about where rents were to where they are today, when I think about where asset values and cap rates were to where they are today, we feel like it's an attractive entry point. I mean, I'll give kind of one data point, which we were looking at a couple of months ago, and actually we're living and breathing it every day, and actually surprised me, which was Austin rents relative to pre-COVID, only up 9%, right? So you think about that trajectory that they've been through, only up 9% relative to summer. That's actually, a couple of percent of growth a year, right? Relative to lots of other markets. And we look at that and think about the price, the point in time, the basis we can get in those assets, and then think about growth going forward over the next 10 to 15 years. We feel like it's a relatively attractive time to be entering markets like that.
So talk about that rent growth in Austin is a really interesting data point, because I've heard you talk, Ben, about in the markets where you are, the delta between living in an AvalonBay apartment and owning the median priced home is currently at $2,000 a month.
Yeah.
Talk for a moment about that gap between renting and owning and what that makes you think as it relates to, if you will, are we going to continue to become a renter nation given that gap? Or do you think that gap comes back down to the point where people can jump from multifamily to single family?
Yeah, it's a huge dynamic and a huge driver of demand spot point in time. As Willy called out, I mean, $2,000 to $2,500 per month more expensive to own a home than rent a home in our core markets. Now, that's driven primarily by our concentration in the suburban coasts, right, where you've seen both huge price appreciation as well as high mortgage rates.
And limited supply of new homes because the home builders haven't been building there.
Exactly. Can't find the land, right? It's hard to have that type of competition. And what that's translated down to us on the demand side is typically, if you look historically, we track why people leave us when they're leaving us as a renter. And traditionally, call it 15 to 17% of people that would leave us to go buy a home, right? Today, last 18 months, that figure's been 8 to 10%.
Yeah.
Like we've never seen those types of figures before. So there is for sure a portion of our customer base that is having to stay with us longer. And that's one of the reasons you see in the overall industry, right, why retention is high and turnover is as low as it is. As we look forward, it's tough to know sort of, where things head over a multi-year period. I think about this dynamic as just providing a pretty significant cushion or margin of safety. I mean, there's a large movement you think about has to happen both in terms of home prices and mortgage rates to even close a portion of that gap. So I do think it's going to be a tailwind for the business over a multi-year period going forward.
It's really, last night I was looking at a chart that Zelman, who's our research organization, put out. And at the beginning of the Obama second administration in 2012 and at the beginning of the first Trump administration in 2016, 45% of renters in America could afford to buy the median priced home. That today is at 25%.
Right.
So only a quarter of the tenants in an AvalonBay community can actually afford to buy a single family home. So to exactly what you're talking about, that protection, if you will, in the markets where you are, particularly given the undersupply on the single family side. I mean, if you go to Nashville or Austin, and you're getting a lot of both single as well as it's oversupplied in both single and multi. So that delta isn't nearly as wide as it is in your core markets.
Yeah, agreed. The other, let me take us this way. Another new growth channel for us, given some of these both population trends, challenges of owning a home. We announced on our last earnings call, we are formally moving into the BTR space.
Yep.
It feels
got 25 sites right now for BTR?
No, not so. We have existing communities that are sort of townhome-ish, and so part of this is I describe it. We think about the BTR space for us as just an expansion of what we already do, sort of an expanding part of our business. I don't think about it as a new business line for us. We've been building garden and townhome products since the beginning of AvalonBay.
Are you partnering with single-family developers on that though?
So our growth channels are we've got existing product in the portfolio that we build up over time. In the near term, it's going to be both buying. So buying BTR product as it's completed, and then funding BTR developers. We have a program that we use on both multifamily, and now we're using in the BTR space. We call it our developer funding program. We provide full capital stack to third-party developers. They've got sites, they're ready to go. We own it. We show up at closing. We buy the land. We fund the entire project. The developer, sort of a typical LP-GP deal, but they're not putting in the upfront capital. They do get to participate in the value creation and earn a typical type of promote. So we've taken that program, which has been successful for us on the apartment side, and now we're bringing that over to the BTR side. One, to be able to activate it more quickly, right? We don't have the presence. We don't have control over that land, so we can leverage third parties who do. We also, there's aspects that are similar to the apartment development space, but there are aspects that are different. Right, it is a product that's built differently, different subs. And so we're going to use those relationships to get smarter and learn more about the business over the next 12 to 18 months.
I think you have a CapEx plan for 25 of about $1.5 billion. How much of that $1.5 billion is in BTR?
We haven't said it specifically. So yeah, we have we are leaning into development today, which not everyone's saying. And our objective is, it feels like a spot point in time where AvalonBay can capture an outsized share of what will be an overall lower level of development starts. I think about our cost of capital. We raised through the public equity markets $850 million at an initial cost of capital at 5%. Looking at leveraging the scale that we have with our teams in the market, we are seeing construction costs come down. Think about, the spread between development yields, which for us, we're finding development yields in kind of the 6.5% type of range relative to our cost of capital, relative to underlying cap rates. All of that has us leaning in. The bulk of the $1.5 billion is going to be apartment oriented. But of that $1.5 billion, and the potential to take it higher would be through more DFP business, more funding of third-party developers, and getting further in our acceleration of our BTR program.
I know you're building to a 6 yield on cost. What happens if rates move up from here? Does that $1.5 billion get pulled back for 25?
Yeah, for sure. Given where rates are and sort of the uncertainty in rates, we're going to need to stay nimble. That's sort of the message and theme that I use with the team. We're in a kind of a continued period of heightened uncertainty, and so we can't get stuck in a plan. What we focus on at AvalonBay, and we've done this over multiple cycles over 30 years, is triangulating in on and making sure that when we're starting new developments at that point in time, we don't trend rents, we don't trend costs. We focus on spot point in time. What's that yield look like relative to the underlying market cap rate and relative to our cost of capital? And we maintain 100 to 150 basis points of spread between those two to effectively provide the protection that's required from development risk, right? So a little bit of it is kind of rate risk. The other part, which is unique to us, and it does come with a cost, but we typically lock in our capital on new development upfront. So at any point in time, we're generally 75%. Today, we're actually overfunded on our new development activity. So one of the ways that we protect against the risk on rates is when we decide we're going to go shovels in the ground, we're matching that project up with discrete capital at that point in time to take the capital cost risk off the table. Doesn't mean there's not development risk, but we're taking the capital raising cost risk off the table when we say go.
And Ben, when you think about 600,000 units being delivered in 2024, 400,000 units being delivered in 25, and then we drop down to right now, the projections are 250,000 units delivered in 26,
yep.
Which is shovels going in the ground now. You got as a developer, you've got to like that sort of step down to 250,000 in 2026. And there are few who can go after it right now like you can because of your financing and the capability for you to raise capital around that. But talk for a moment about absorption and whether you think that 26 is going to be the Shangri-La that lots of people are thinking it's going to be because it's undersupplied versus that oversupply in 24, 25, lagging into 26 and not allowing owners to push rents as much as many are projecting in 26.
Yeah. One call out I'll make up front, and hopefully this resonates to the developers in the Mid-Atlantic, is there's a ton of focus on supply coming down in the sunbelt. Supply is also coming down on the coasts and coming down particularly in the suburban coasts. So I do think it's going to be a benefit as you look out over a multi-year period. Obviously, there's less starting. There's going to be less competition. But I think there's an over kind of heightened focus on supply coming down in certain markets where I think it'll happen in the overall industry. So that's point number one. Point number two is I'm generally of the view that there is going to be a longer tail from supply, particularly in places that are seeing, go into the Austins of the world, just historic levels of new supply coming through the system. I think as we get into 2025, we start to be a little bit of a bifurcation in some of the high supply markets and some of the Sunbelt markets. I think some of those markets will make their way through the bulk of new deliveries in 2025. Still have, challenges around maintaining occupancy, still have challenges around rents, the roll through of that in terms of NOI into 2026. I think people, at least in the public arena, our investors get very, very focused on rent change. And we're trying to reorient them like that rent change. You got to build your rent roll over a year. Like the dynamics that exist today are going to roll through rent rolls over the next 12 months. And then there'll be certain markets. So I think there'll be a set of Sunbelt markets that, return to normal as we get maybe rents start to inflect in the back half of 25. The NOI impacts roll through in 26. By the time you get to 27, things feel a little bit normal. But there's also a set of markets where it's probably another year behind. I mean, we're in one of them, and we went there consciously knowing there was going to be a lot of supply, but people have been to the South End in Charlotte as an example. I mean, just go and look at the cranes that are still in the sky. Like there's deliveries that are going to be coming there for another 12 plus months, right? So that first category I just described, you got to advance that another 12 to 18 months before you're on the other side of a more normal, supply demand dynamic. More broadly, our outlook for next year got a lot of flavors of sort of similar to this year. I mean, what we saw this year was East Coast continue to outperform West Coast. Both the East and West Coast outperform the Sun Belt. And next year, as you think about from a jobs perspective, generally things have changed a little bit, sort of a little bit more momentum around potential jobs next year. But jobs are expected to come down in 25 relative to 24. Supply is also coming down in 25 to 24. But if you look at the job to supply ratios, at least sort of spot point in time, they're pretty similar year over year. And so for us, when we think about what are the markets that are going to underperform or outperform in an environment like that, it's going to continue to be driven primarily by where there are higher levels of supply. And so as we think about next year, I think our expectation is, at least for another year, where you've seen momentum in markets is likely going to be the places where you continue to see that momentum.
And when you think about either the new administration or local governance in the markets where you all are, first of all, obviously rent control in California didn't pass, which is huge for you all and some of the other large REITs that have significant assets in the state of California. As you think about the Trump administration coming in from a either general economic standpoint or more specifically to housing, you excited about it? You concerned about it? What's your sense as it relates to the economic backdrop and more specifically to housing?
Yeah, I'll make a couple of comments. So on the regulatory front, see it as a net positive. As everybody knows, most of the regulations that we deal with are at the state and local municipal level, but there was a lot of rhetoric coming, more and more at the national level in and around rent control. We continue to be big believers that to solve our housing problems in the country, they need to be supply-based solutions. So I think that'll be a net positive. As it relates to the economy, obviously very challenging to forecast what policies are going to be implemented, what the implications of those are. It seems like economists generally are now expecting slightly higher growth. That higher growth may come with higher interest rates. So on the growth side, I think that growth should benefit apartments. I think there's a case to be made, particularly for our type of customer, that more of that growth and more of the wage and income growth that'll come from it should be our type of customer. You just think about deal activity, financing activity, sort of the parts of the economy potentially could get going that have been a little bit subdued. So I think that's a potential kind of net positive there. Rates staying higher likely translate over into cap rates staying higher for a period of time. So that's a headwind on values. So kind of an absolute net negative. Now, at the same time, in my AvalonBay seat, to a certain degree, it extends out the period of time where I've got a pretty significant cost of capital advantage, right? So like from an absolute level, from apartment values, higher rates are a net negative, but you think about where I'm raising cost of capital relative to where a private developer could raise cost of capital, that's pretty wide today. And so if we stay in that type of environment, probably extends out our period of time where we can use that advantage to capture our share of growth.
And Ben, given your background of having been in other asset classes and now being focused solely on multifamily, bear with me as I give a couple data points and then ask you the question. But I went out and looked at office, retail, multifamily, data centers, and industrial, and picked up 5 REITs to look at how they performed over the last 10 years. Yeah. Okay. So if you look at Boston Properties, for instance, this won't surprise anyone, $14 billion market cap, down 40% over the last decade. You then go to Mid-America, a competitor of yours, $19 billion market cap, 120% growth over the last decade in their stock. You then go to Simon Properties, $70 billion market cap, flat over the last decade if you'd bought Simon Properties a decade ago. Equinix, $92 billion market cap company, data center focused, and won't surprise anyone in the room, 320% growth in their stock price over the last decade. Yeah. And then finally, Prologis, $108 billion market cap company. And if you invested in Prologis, you're up 170% over the last decade. So a couple things there. First of all, Mid-America, that 120, AvalonBay's up 42% over the last decade. What are you going to do to have the growth of AvalonBay beat Mid-America? That's my first, start on that, and then I'm going to come back on others.
Yeah. I definitely take a long-term perspective on it. We've been at this 30 years. We've delivered a 11.5% annualized compounded return to shareholders over that time period. And to be able to do what we do and deliver that type of consistency, both dividend growth and share growth, it's an amazing platform. And underneath that is multifamily. We're in an amazing asset class, right? We're connected to the growth of America. We're connected to wage and income growth of our country. And so I look at that longer term, and I think it's just, we're in an amazing business. And of all the asset classes, I look forward, a lot of the other ones you touched on, even the ones that are sort of everybody's favorite asset class today, I think people have a harder time envisioning what those asset classes look like 10, 15, 20 years from now. And our business will evolve. But in terms of being disrupted, by some other changes, I think we've got, the least risk associated with that. And so when I think about both from a shareholder perspective, kind of wealth preservation plus growth, come to multifamily. We want to do that over a long period of time. We're a beautiful place to be.
And so then on that, if I said to you, you've got $1,000 to invest in the stock of either an office REIT, I said Boston Properties down 40%, yeah. A retailer like Simon Properties that's flat over the last decade, Equinix that's in the data center space, or Prologis that's in the industrial space, where would you put your money? Outside of multi. A recovery in office, growth in retail, further on data centers, or more industrial?
As much as it is the more than the flavor of the day, as much as there's an intense focus on capital flowing into data centers, the time I spend with some people who lead our industry, and to hear them say, if they had that dollar, they would put every dollar they had into the data center space. So outside of apartments, at least over the next couple of years, I think there continues to be a momentum to ride in that wave.
I will say I was at I was at a conference up in New York 2 days ago, Ben, with it was Milbank and Goldman Sachs on data centers, and they had 80 CEOs of the big data center, either investors or operators. I was completely a fish out of water, completely. And Wes Edens from Fortress was up talking about the data center space because new Fortress Energy is a big energy supplier to data centers. And Wes was having a conversation with Andy Jassy at Amazon just a couple of weeks ago. And he said, Andy, what's the trajectory for growth in data centers? To which Andy Jassy said, Wes, I don't know. To which Wes was like, if there's anyone on the face of the planet who should know the trajectory for data center usage, it should be you. But what Andy did say was every single time that there is a new unit of capacity created, it is gone instantaneously.
Yeah.
And from a supply-demand standpoint, that's not a bad place to be. It's really not a bad place to be.
I don't want to miss your question about Mid-America, who I do admire. We admire them as an organization. I think highly of Eric Bolton. Our focus as an organization, and we did a big investor day on this last November, is we are laser focused on delivering superior growth over the long term. And what we're focused on are a series of activities that we think can consistently drive that growth. And it goes to the operating model transformation that I talked about before. Just a quick kind of tidbit there. Currently, over the next couple of years, we think there's $80 million of annual incremental NOI, both from increased revenue and from operating efficiencies, to come out of the investments that we're making in our operating model transformation. Yeah. Continuing to leverage our development capabilities. Right? We have a really unique in the public sphere. There are a lot of private developers, but in the public sphere, I'll give you guys this stat. Over the last 10 years, we've developed more than all of our public multifamily peers combined. So we have a self-generated way to generate external growth that we're going to continue to lean into and take into some new product classes and new arenas. And then also we need to be constantly adjusting and thinking about portfolio allocation and asset management. I think there's opportunities as we optimize those activities. They should also lead to superior growth. And then I bring it all back to, MAA's got a good culture, strong culture as well. But at the core of it, if we're going to have best-in-class teams, best-in-class people, we need to continue to have a unique culture that keeps people engaged. We're able to grow their careers. That at its core is going to lead to our long-term success.
Yeah, and I would underscore the fact that, your market cap is $32 billion. MAA's market cap is $19 billion. So you got $13 billion more of market cap, and they have more units than you do. So your value per unit is significantly higher than they are. So it's exactly what you're talking about there. You have a huge opportunity there given your size and scale. You're bigger than EQR, you're bigger than them. You're the largest apartment REIT in the country.
Yeah.
It gives you big advantage from a cost of capital standpoint and a growth standpoint.
Yeah. And it goes back to the level of investments that I believe and we believe are going to be necessary in and around technology and centralization and the benefits we can increasingly drive through owning clusters of assets. It's going to be increasingly important. And I think there'll be some separation there relative to the public peers, but to a certain degree, we're kind of all headed down a similar journey there. We're all of us significant size and scale where we can make those investments. I look forward, I think likely more of the differentiation is going to happen between some of the smaller private operators where those assets on our platform, we will be able to generate outsized growth. And so that leads me to everything as we're seeking out development deals, as we're thinking about portfolio opportunities. It's the asset specifics, but I'm really focused on finding opportunities where I can leverage our scale to generate outsized growth.
And my final question for you then, Ben, if you look at your competitive set as it relates to a Mid-America, to a EQR, the big publicly traded REITs, then they're the private equity owner operators of the Blackstones and the Greystars of this world. And then there are the, if you will, someone like Monarch that's Bob Nichols, and he raises money from sort of a non-private equity type model where he's just getting various investors to come in, and Bob's now a top 10 owner. As you think about that competitive landscape, who's the real competitor? Is it the other REITs? Is it the private equity firms, or is it the smaller operators that can kind of niche the market?
It's all of the above. And the private equity guys, given their scale, the capital that they've been deploying in the space, they built up some very sizable platforms, and so I think increasingly they will be seen as a competitor of ours. But it's different, right? They're generally investing through third-party managers. Some of the other models you described, right? People at the center of operating the assets have lots of different capital partners. I think what distinguishes us, partially the REIT model, but then also AvalonBay, is we are wholly owned and we're wholly owned for the long term. And so it allows us to make investments at a level that a lot of the competitors in the multifamily landscape just can't make.
Yeah. Ben, thank you very much. It's been a real pleasure.
Yeah, thanks for doing this, Will.
Thanks, everybody.